This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Surprise rebound. Stocks snap back as investors focus on the three pillars of the market: the economy, interest rates, and earnings.
Securing your retirement, how you can protect your savings in a market with more than the normal number of question marks.
Disrupting class, what some startups are doing to change the way we learn throughout our lives. Those stories and more tonight on Nightly Business Report for Tuesday, March 28th.
Good evening, everyone, and welcome. Stocks surged today as investors went shopping for equities, putting to an end the Dow's week-long slump. Today, it wasn't about Washington or healthcare or tax reform. It was about getting back to basics. Investors turned their attention to upbeat reports on the economy, comments on interest rates from an influential member of the Federal Reserve, and corporate profits. The Dow Jones Industrial Average snapped an 8-day losing streak, rising 150 points to 20,701. The Nasdaq added 34, and the S&P 500 was up nearly 17. Let's start with earnings. The end of the quarter is only a few days away, and already the expectations are high. Bob Pisani explains.
The end of the first quarter is just around the corner. The bulls are hoping a strong earnings season may provide a market stabilizer for what is likely to be a very rocky debate over tax reform and infrastructure spending. First quarter earnings are now expected to rise more than 10% from the same period last year. That would be the best quarterly showing in nearly 6 years. Now, the early signs indicate the earnings might even be a little bit better than that. The first 12 companies that have reported first quarter numbers, Micron and Nike, Oracle and R, they've reported average earnings gains of about 12%. Those 12 have also seen the best quarterly gains since the second quarter of 2014. And it's not just earnings. Revenues are expected to jump more than 7%. That will be the best growth we've had in about 5 years. So what's the key to these rising numbers? Well, the two biggest sectors in the S&P 500 are technology and financials. They're set to deliver earnings gains of about 15% apiece. That's huge. These are the two biggest sectors. Second, energy earnings. After nearly 2 years of declines, you know what's going on there. They've turned positive as well. So is there any risk? Well, yeah, the big one is to oil. Big oil's ability to pull off big gains in 2017. It seems problematic. Oil's in the mid-40s, and many of the earnings estimates for oil companies were developed with oil closer to $60 a barrel. But the average price for oil this quarter was $52, and that might be enough to pull off expectations for earnings for the oil companies this quarter. The bottom line is the markets are about to enter a seasonally weak couple of weeks just prior to the April 18th tax deadlines, and any good news on earnings will be welcomed by traders. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And with a plethora of uncertainties facing the markets in the coming months, how should you position your portfolio? Joining us now is Paul Schatz. He is the market strategist and president of investment management firm Heritage Capital. Paul, nice to have you here. Welcome.
Thanks, Sue. Thanks for having me.
Let's start. You think that investors should use the weakness that we saw in the last couple of days to add to positions. Why?
Well, first of all, nothing new. Stocks are really still the only game in town. It's been that way year after year after year during the secular bull market. It remains that way today. We've gone through an 18-month, you want to call it a stealth bear market, you want to call it an earnings recession, whatever you want to call it. I liken it to 1994. 2004, we've had a year-long plus period where stocks kind of regather themselves, pause to refresh, and now earnings are kicking up into high gear, as Bob just mentioned. The economy is more stable. The economy is growing better than it has in a while. And the DNA markers that you typically see before a bull market ends are not present today. So although the bull market is very old, it's wrinkly, it's not over, we should tick at least 23,000 before the bull market ends.
Old and wrinkly, but not over. You're describing how I feel right now, Paul. Let's turn to those earnings, which I think are really important. Are earnings really good and getting better, or were they just so bad a year ago that they look better by comparison today?
Sure, Tyler, and you're not old and wrinkly, because you got many, many more years left of this. But to your point, we're talking about comps. I mean, remember, the first quarter of last year was disastrous.
Right.
So it was right at the end, really, to the end of that pretty good earnings
So
recession.
are corporations
so the
really
comps
that much healthier today than they were then, or are we just looking back to a year where they batted 220 and now, by comparison, they're doing better?
I think it's twofold. One, the comps are easy. I mean, anybody can walk over those comps. It's not much trouble at all. But also, look, we know that either whether you want to say it's coincidental or because of the election, the economy is doing better. Look at consumer confidence. Look what CEOs are saying. People feel better. They feel like there's a hugely strong pro-growth agenda, the strongest since either Bush II's first term or even back to Clinton. People are feeling better. Their economic prospects, the average person is feeling just a little bit better than they did. So whether that's fiction or reality, it's certainly contributing to the economy and the markets.
Very quickly, with the last 30 seconds, on the sector side of things, where would you put money to work?
Well, assuming I had at least a little bit of growth or a balanced portfolio, I think you have to start with large cap. Unless you're a really aggressive investor, there's nothing quote unquote safe about stocks, but I definitely, on any dip, any weakness, you have to be a buyer of stocks. And I'd look at, if you're an index investor, just stick with the S&P 500. Don't overthink this. If you have a little more time to research, I think Europe offers some values for people. I'm really concerned about the bond market long term. I don't mean the next couple of months, but I would use rallies in the bond market. A lot of people own tons of treasuries and regular bonds. Do the exact opposite of dollar cost averaging. Dollar cost average out of bonds, into stocks, into some commodities, protect against inflation.
Paul, thank you so much. Paul Schatz with
Thanks,
Heritage
Thanks, Tyler.
Capital.
You bet. All right, more now on that upbeat economic news we told you about. Consumer confidence jumped in March to levels not seen since the year 2000. The optimism driven by solid job growth, wage growth, along with rising stock prices and cheap gas. The Conference Board's confidence index is used as a gauge of future spending, and in theory, as confidence rises, consumers spend more. And that, of course, is a key part of overall growth because consumer spending, as we're fond of reminding you, accounts for about 70% of U.S. economic activity.
And home prices rose at the fastest pace since 2014 and are appreciating at more than twice the rate of inflation and wage growth. According to the S&P Case-Shiller Index, single-family home prices rose nearly 6% in January. As we've been reporting, lean housing inventory is helping drive those prices higher. But those high prices are also making it difficult for some Americans to transition from renter to homeowner.
And now to the Federal Reserve. Of course, every investor wants to know what the second most powerful central banker in the U.S. thinks of the economy and the direction of interest rates. And today, Vice Chair Stanley Fischer shared some thoughts with Steve Leisman.
Among his central banking colleagues, Fed Vice Chairman Stan Fischer has generally been someone who wants to hike interest rates a little bit more and a bit sooner. So it's news to the markets when he says, as he did today in an exclusive CNBC interview, that he's aligned with other Fed members who want to raise rates just twice more this year. With the average forecast of 2 rate hikes this year, does that seem to you to be about right? Should the market prepare for possibly more, possibly fewer?
Well, that seems to me about right. That is to say, that's my forecast as well. I think the risks are more or less balanced.
Part of Fischer's reasoning, the recent failure of the Republican health care bill, which he says has changed his, quote, internal calculus about how much fiscal stimulus can come from Washington this year. He said the Fed is right to wait and see which of the Trump administration's policies are adopted rather than acting preemptively.
It's a sensible thing to do. I mean, you get out there and say, I expect a deficit or of such and such a size and tax cuts of such and such a size. You know, it comes from the administration. It'll go through the Congress. It'll be different than what went in. And I think that's a good way of doing it.
For example, Fischer said tax cuts, if they're enacted, probably won't affect the U.S. economy until 2018 at the earliest. Another reason for the Fed to be cautious about counting on too much growth, the possibility of trade protectionism from the Trump administration.
I'm concerned about the possibility that something that all in all worked very well, which is the policies put in place after World War II and that continued until recently, that worked spectacularly for China. It worked for us. We've been able to buy many, many things that we wouldn't have been able to make had it all been up to us. Mm-hmm. So we benefit from that as well. I'd be concerned if that basic model is overturned.
So Fischer may yet end up being a Fed official who wants to hike more and hike sooner. But he made clear he'll only change his outlook when he's sure the policies are going to change as well. For Nightly Business Report, I'm Steve Leisman in Washington.
A General Motors investor says the automaker is not firing on all cylinders, and he has an idea to change that. Greenlight Capital's David Einhorn is now calling on GM to split its stock into two classes. He wants one class to receive GM's current dividends and another to be more growth-oriented. In a phone interview earlier today, Mr. Einhorn explained his plan.
I would compare it to an ice cream stand that just serves chocolate and vanilla swirl ice cream. If you gave investors more choice, some people like chocolate, some people like vanilla, some people like swirl. If you implemented our policy, you would wind up with one share of each. So if you like the swirl that you have today, you could keep the swirl. If you would like just more dividends, you could sell the capital appreciation shares and buy the dividend shares. If you like just the capital appreciation, the low multiple, then you could sell the dividend shares and buy the capital appreciation shares.
General Motors is not buying the chocolate, the vanilla, or the swirl. They say the proposal creates unacceptable risks and is not in the best interest of shareholders. Shares of GM up about 2.5% today.
And Ford Motor plans to invest more than $1 billion in 3 Michigan plants, adding 130 jobs. The president applauded the move earlier today on Twitter. The investments were in the works, though, before President Trump took office, and the announcement comes about a week after the automaker provided a first-quarter profit outlook that was below expectations.
The White House wants to bring back coal jobs. In an effort to do that, the president today reversed some Obama-era energy policies. While the industry applauded the move, others say fixing the coal industry won't be easy, especially now that other fuels are cleaner and cheaper. Eamon Javers reports.
The Trump administration took steps Tuesday to begin dismantling Barack Obama's climate change efforts, or what this White House calls his war on coal.
We will put our miners back to work.
In an executive order, the president initiated a review of Obama's Clean Power Plan regulation on emissions, with an eye toward rolling it back in the future. Trump also rescinded Obama's coal leasing moratorium and began reviews of methane rules and the Bureau of Land Management's hydraulic fracking regulations.
We're ending the theft of American prosperity and rebuilding our beloved country.
One of the problems the Trump actions will not fix for the coal industry is economic. Coal has lost market share as natural gas has become more inexpensive and available. The White House said it did not have an estimate of the number of jobs its actions would create.
I see it maybe eliminating or reducing the reduction of coal and jobs. I definitely don't see it as a revitalization of the industry. The coal industry is having to compete with natural gas, and that's been the biggest problem.
The energy industry largely applauded the move.
One of the greatest advantages America has is its natural resources. And now what we can do is unleash those forces, whether it's nuclear or coal or gas or renewables or even kind of new models for energy efficiency, to really play offense and grow jobs and grow personal incomes and make lives better.
The White House dismissed the concerns of environmentalists who said the president's actions could have disastrous consequences. A senior administration official here at the White House said the best way to protect the environment is to have a strong economy. Right. For Nightly Business Report, I'm Eamon Javers at the White House.
Still ahead, conflicting signals, how you should manage your retirement savings in an uncertain market.
Wells Fargo has agreed to pay $110 million to settle a customer class action lawsuit over its fake account scandal. The settlement still requires court approval and will cover customers who put in a claim that the bank opened an account without their consent. In September, Wells paid $185 million to settle with the government.
Corporate America is always focused on policies out of Washington, and no more so than now. But for the fast food industry, the unanswered questions are starting to pile up. Sarah Eisen talked to one of the biggest players in fast food, the CEO of Yum Brands.
The fast food industry has seen slow progress on the policy front. The failure to repeal and replace Obamacare in the House, denting some franchises' hopes to mitigate health care costs for employees. Andy Puzder, the former CEO of CKE Restaurants, parent company of Carl's Jr. and Hardee's, no longer in contention to be the labor secretary. And there have been recent executive orders cracking down on immigration, threatening one of the biggest industries that employ immigrant labor. But Greg Creed, the CEO of Yum Brands, parent company of Taco Bell, Pizza Hut, and KFC, is optimistic, particularly about the prospects for tax reform.
A lower tax rate I do believe would increase investment from people, and because remember, our corporate tax rate is low, but our franchisees live in an individual country, so our US franchisees would have probably a higher tax rate than we have. So I think lowering the tax rate, particularly as we move to being a more franchised business, would be a good thing for our industry.
And if we get personal tax cuts, I would think that would be helpful for your consumers.
Absolutely. If we could deliver tax cuts to the middle income in the US and below, that people will spend money.
Creed is also hopeful that deregulation will go a long way toward helping the restaurant industry.
We just need to make it simple. You just can't have differing standards, when the federal government has one and the state government has another and the local authorities have another. It just makes it particularly difficult. And in our case, it's our franchisees who are doing most of the investing in the US, and regulations can just, drives them insane and drives them away from investment.
There's also hope that the spike in consumer sentiment after the election will translate into higher spending. Creed describes the U.S. consumer as still value-oriented. So, despite some possible early setbacks on a policy front, the fast food industry still has a lot of room for improvement and hopes of a bump in business from Washington. For Nightly Business Report, I'm Sarah Eisen outside Jacksonville, Florida.
Shares of Cara Therapeutics pop on positive trial results, and that is where we begin tonight's market focus. The biotech company said its medication for a chronic condition related to kidney disease that currently has no approved treatments in the U.S. performed well during a trial. Cara Therapeutics said it plans to discuss next steps with the Food and Drug Administration. Shares up 5% to $19.09. More positive news on the biotech front. Drug makers Regeneron and Sanofi said the FDA granted approval for the company's joint eczema drug. The treatment will carry a list price of $37,000 a year. Regeneron shares were off a fraction at $382.55. Sanofi essentially flat at $45.35. And Carnival said strong demand for Caribbean cruises and higher onboard spending helped profit top expectations. The company also said it is seeing strength in the number of bookings for the remainder of the year, prompting it to raise its outlook for 2017. Carnival shares 39 cents higher at $59.26.
Shares of Darden Restaurants continued to surge today following the company's stronger than expected earnings that came out after the bell last night. The owner of Olive Garden also gave an upbeat full-year forecast, profit forecast that is, and said it was taking over restaurant chain Cheddar's Scratch Kitchen for almost $800 million. Darden up 9% to $82.62. The competition between Facebook and Snapchat is heating up. Facebook launched 3 new features that are very similar to current Snapchat offerings, including the ability to add filter effects to your pictures and send video and photos directly to your contacts. And Wall Street took it out on Snapchat today, sending shares down about 7% to $22.21. Facebook was up 1% to $141.76. Restoration Hardware posted profit and sales that were ahead of expectations. The upscale home furnishings retailer also gave upbeat guidance for the current quarter and noted that the most uncertain stages of the company's transformation were behind it. Shares initially rose more than 10% in after-hours trading, adding on to a 3% gain in the regular session, where they finished at $38 even.
With uncertainty lingering heavily in the market these days, what should you be doing right now to protect your retirement savings? Here with us to discuss is Rick Edelman, founder and executive chairman of Edelman Financial Services. Rick, always good to see you. I want to begin with a question that's a little off topic here. Let's assume for a moment that I, as a result of this very nice run in stocks, now have more stocks than I'm comfortable with, 70% as opposed to 60%.
Right.
We're talking retirement accounts here. I want to get back to 60%. Should I sell stocks within my tax-sheltered retirement plans or outside of them to get back to my ideal mix?
Given the choice, do it inside your retirement account because that way it's tax-free. If you were to do it outside the account, you're going to incur a capital gains tax on the sale of those securities at a profit. So you're absolutely right. Do it inside the tax-deferred account. You're also right about the fact of rebalancing back to your desired allocation model. A lot of folks miss this point, and I'm really glad you're raising it because they don't realize that with the run-up of stocks that we've enjoyed since the election, your portfolio's allocation is different than it was just 6 months ago. And if you don't pay any attention to that, you could be taking a lot more risk today than you realize.
What about the emotional component of investing? It's all nice and rosy and sunshiny when, we have a big rally, but when we do get dips and volatility increases, the emotional aspect tends to come back in with the individual investor.
You're absolutely right, Sue. It's really fascinating. Nobody ever complains about upside volatility. It's
right.
only the downside volatility everybody gets upset about, but you can't have one without the other. So if you're going to find yourself nervous because you think a market correction is in place, that the president's agenda is now weakened because of last week's activity on the Hill, if you're nervous and it's causing you to lie awake at night, that is an indication that you have too much of your money allocated to equities. And this is a wonderful opportunity to rebalance that portfolio. And when you do, focus on your tax-deferred accounts as the opportunity to do that.
Let's talk a little bit about the possibility of a correction in equities. We went 8 days in a row with Dow losses. It was a long streak, but really a relatively small decline in prices. Should you look at corrections as opportunities to buy more or what?
Yes, or ignore them entirely. I mean, let's remember that we haven't seen a week like we've just had since September. And so the stock market isn't meant to rise the way it has since the November election. At one point, we were running at an annualized pace of 70% a year. Well, we know that's unsustainable. So it's inevitable that the stock market's either going to go flat for a while, which is kind of what we've seen, or even decline, maybe a lot, to get back to the normal rates of return that we typically experience.
70% a year from your lips to my portfolio, yeah. Rick. Thanks.
Right.
We appreciate it. Always good to see you. Rick Edelman with Edelman Financial Services.
Thanks.
Coming up, making the grade, why classrooms today and in the future will look a lot different than they did just a couple of years ago.
Here's a look at what to watch tomorrow. Bids from companies looking to help build President Trump's proposed Mexico border wall are due. A number of Fed officials will speak on the economy, and the UK Prime Minister is expected to trigger Article 50. That's the mechanism that will start the process of leaving the European Union for Great Britain. That is what to watch tomorrow.
Speaking of which, Scottish lawmakers today voted in favor of a new independence referendum, and that gives Scotland's First Minister the okay to ask the UK Parliament for a referendum between later this year and early next year. The British Prime Minister has indicated that she will reject that timetable. Theresa May says that now is not the time for a vote on the breakup of the United Kingdom because Britain is expected to leave the EU in 2019.
Well, remember when you sat at your desk in school and listened so intently to your teacher as she wrote on the chalkboard, or he wrote on the chalkboard? Well, walk into a classroom today and things are a lot different thanks to some startups that are turning education inside out. Julia Borston, always attentive, has our story.
With about half of the highest paying American jobs now requiring some coding knowledge, a range of startups are looking to close the skills gap. Targeting mid-career adults looking to get better jobs, startup Coursera is partnered with 150 universities around the world to offer 2,000 courses, along with professional certificates and digital degrees, and custom training for companies including IBM, L'Oreal, and BCG looking to advance their employees.
There are many, many jobs requiring middle or high-level skills that go vacant, even while many other jobs, many other people are unemployed or underemployed. And so we think there's a real opportunity by giving people the opportunity to acquire new and better skills.
Coursera rival Udacity is focused on the tech sector, with 25,000 students enrolled in one of its nano degree programs on topics including robotics, digital marketing, and self-driving cars.
And as early as kindergarten, technology is transforming the classroom and leveling the playing field as teachers around the world embrace software that finds best practices, helps them manage assignments, and submit evaluations.
Learning management systems such as Brightspace and Blackboard are already a $5.2 billion industry, projected to triple in 4 years. And Google, Microsoft, and Apple are all now offering free classroom tools. And outside traditional curriculum, toy startups are lining up to offer kids fun ways to learn valuable coding skills. Osmo connects iPads with real-world objects like pen and paper and blocks. Its most popular Explorer kit costs $189. Wonder Workshop brings coding to life by teaching kids to program robots called Dot and Dash. The pair costs $200 and has been adopted by 10,000 schools worldwide.
So these robots are actually very affordable for the teacher, and that's been a core focus for what we've been trying to do, is to make the technology very affordable for these teachers and for parents.
The global market for child development toys is projected to reach nearly $40 billion by 2019, with over 3/4 related to science, technology, engineering, and math. Part of the growing EdTech market, helping children and adults learn the skills needed for a fast-changing workforce. For Nightly Business Report, I'm Julia Borston in Los Angeles.
And before we go, here's another look at the day on Wall Street. The Dow rose 150 points. The Nasdaq added 34, and the S&P 500 was up nearly 17. And that does it for us on Nightly Business Report. I'm Sue Herrera. Thanks for joining us.
And thanks from me as well. Have a great evening, everybody. I'm Tyler Matheson. We'll see you tomorrow.